Welcome everybody to the Win Your Wealth podcast, where we teach you how to win your wealth by investing, savings, budgeting, and more. Now let's get started with the episode. Welcome to the very first episode of the Win Your Wealth podcast. First and foremost, I would like to just sincerely thank each and every one of you for being a part of this thing that I'm trying to do, this value that I'm trying to deliver to the space around personal finance, individual wealth, and just thank you very much for downloading this podcast and giving me the time of day and the opportunity to at least try to help people out there that are trying to win with money, to win with saving, win with paying off debt, or whatever your financial goals are. I hope that you can get just a little bit better by listening to this podcast. Now, I promise you that I won't spend the majority of this episode talking solely about myself, but I think it warrants the fact that this is the very first episode of this podcast, who I am, where I come from, and what I am trying to do, and what kind of value am I trying to deliver in this podcast. I think at least a small segment that I'm going to call About Me is in order. So in this segment, I'm going to talk a little bit about who I am and why I've decided to build this podcast and what I'm hoping for it to become. Like I mentioned before, my name is George Almazan. Really, my real name is Jorge Almazan, but a lot of my friends just have called me George throughout the years. I don't know why. It's okay with me though. So I think either way, whether it is the Spanish or the English translation of that name, it's a common name anyway. So hopefully you all remember me by also my last name, which is not a very common name, which is Almazan. And I am a 28-year-old person from Texas. I'm a Texan. I live down here in the Rio Grande Valley area, which is where, if you're familiar with the state as a whole, you probably believe that San Antonio is the southmost part, or Houston is the southmost part of Texas. But the truth is, the very, very tip bottom of Texas is a little area called the Rio Grande Valley, or the RGV. And I live in a town called Edinburgh, Texas. This entire area is like a metropolitan. More than 1 million people live here. It's kind of like a little island between sort of the middle of nowhere, because literally it's a bunch of nothing all the way till you get north to San Antonio for about 3 hours or so, maybe a little more. And then right below us to the south is Mexico. So I like to think of it as living on an island down here. It's a very great place to live, and I've lived here my entire life. I've been able to strive and live. I'm married. I've been married for about 2 years, and I have 2 dogs, no kids, and we recently bought our first home. My financial journey as a whole started probably about 6 years ago, if I had to estimate, maybe a little bit later than that, but for sure around 6 years ago. I've been blessed with a lot of great things in my life, and family has been one of those things. I had an uncle of mine who taught me a trade. I am in information technology, specifically in the network engineering realm. And at the time I went through college, I learned a lot of stuff from my uncle who had a business in this. And I was able to get a lot of experience, enough so that right after college, I was able to land a great job and went through a couple of different job changes. And at some point, I realized that hey, look at that. I have student loan debt and I have some credit card debt that I need to pay off. And what is this whole idea of money? I mean, I knew that it was important. I knew it was something that I didn't have a lot of growing up, frankly. I grew up in a single family household. My mom spent a lot of time with the abuela, with my grandma. And there were some months that weren't so great, right? Single parent, teacher, 2 kids. Not easy for my mom to do that, but she was able to provide me with, of course, the bare necessities and even more at some point. But I couldn't say that we were ever really thriving with money. And there's a lot of things that I didn't know about the world of personal finance until around this time, 6 years ago, where I really started thinking to myself, I have this income and it's not a whole lot, but I would like to make more. But with the money that I have today, I would like to know how I can best utilize that money and how I can make sure that this either builds something for the future, or how can I best utilize it today, right? So I think a lot of us, I think, have that point in our lives when we think about money all of a sudden, right? For some of us, is every single month when we have to pay our mortgage or our rent. For some of you, is every single month when you create your budget. Some of you guys are already doing that, and that's great. For me at this point in time, it was, hey, I am making an income now, a quote-unquote significant income at the time, and I need to know how to best utilize this money so it doesn't all just run away from me, right? So I did what any logical millennial would do, and I went straight to YouTube. Right? I think you can learn a lot through YouTube, by the way. You can find me on there at, if you look up Win Your Wealth, you'll find a couple of my most recent videos on personal finance. Hopefully you find that useful. But I went to YouTube and I, of course, found probably the most popular personal finance expert out there, or I should say syndicate, which is Dave Ramsey. And so I started following a lot of his material, right? His books, his podcasts especially. Used to listen probably to over 3 hours of content pretty much every single day religiously as I was working. Started gaining more and more skills in my job and eventually took on another role. I began making more money than I had at any point in my life, and probably more money than I thought I would ever make at any point in my life. So the truth is that now at this point, I had maybe about half a year or so of listening to the ideas that Dave Ramsey talks about. And to put it lightly and to summarize, he talks about getting out of debt. He talks about having a budget, pretty much sound advice from the get-go for anybody who doesn't have any idea on what to do. I would definitely recommend for you to definitely look at his podcast, look at his YouTube channel. At the same time, I would like to also preface that by saying anybody that shares information freely online, I think a majority of those people are doing it good-heartedly, like myself, like Dave, like other people. But always make sure that you have to take everybody's opinion and everybody's advice with a grain of salt. And you got to think about the source that's delivering it to you. That's all I'll say about Dave and about others and about myself in terms of advice and things that you hear over the air or over podcast. Definitely take it with a grain of salt and think critically about the things that you're listening to and see if it really applies to your life on a day-to-day basis. Because what I found is a lot of the things that Dave helped us with, my wife and I, at the time I believe we were still just dating and moving towards engagement. He helped us quite a bit to deliver and create a plan, not directly, but through his books, budgeting, things like having a debt payoff plan, figuring out the best way to do that for us, how to utilize credit cards, or in his world, don't utilize them at all. My opinions on that have changed a little bit throughout the years. All in all, following his baby steps, which is what he's known for, baby steps 1 through 4, which is where we're at right now. We're on 4, 5, and 6. Pretty much to the T. We were able to get out of debt, save up 3 to 6 months of emergency fund, and ever since there, I was pretty much hooked. I was hooked on the idea of winning with money, right? So, of course, moving in with my wife and I, we became very much a couple that talked a lot about money and the importance of that. And we continue to do that to this day. And a lot of it is because of this podcast and this individual that we listened to together. And we even took his course. I see how much of a change that he's made in the world. And it's honestly part of the reason why I am creating this podcast, because I definitely want to be a person that makes a positive change in the world when it comes to money and personal finance and wealth building for the individual investor. So that's pretty much where we started together. And I know I said that this wasn't going to be a podcast all about me, and I think there will be many, many opportunities in podcasts to come to talk a little bit more about what happens and more about me and my day-to-day life later. But for now, I think that's a good primer to where I come from, just a general about me, so that you can understand who I am. Now, what are the things that I want to come out of this podcast? Like I mentioned before, I mean, a lot of the, I guess, inspiration that I got is from Dave and other people out there like Graham Stephan, Jeff Rose, that have content on YouTube. And I really wanted to have a platform that I believe that I could strive in. And frankly, I don't think that I'm the greatest video editor or content creator for YouTube, but I do think that I could do better when it comes to voice communication and that kind of stuff. So I'm giving podcasting a shot. I really believe that I can reach a larger audience. And as busy as a person that I am, I believe that this platform gives me sort of a better flexibility and easier and more concise methods to bring more content out to the public. And I love podcasts. Honestly, I love listening to podcasts, so I think making one would probably be just as fun. So I hope that you guys find some value. And if you do, I would highly encourage you guys to let me know. I mean, check me out either on Instagram. You can find me on Win Your Wealth, of course, on Instagram. You can find me on YouTube, Win Your Wealth. And you can also send me an email. For right now, I'm just using winyourwealth@gmail.com. If you have any questions or anything that you would like me to answer, go ahead and leave it there. So I think that's enough for this particular segment, and let's get into the next one. So this segment is a segment that I'm probably going to do in literally every one of my episodes, and I'm going to call it, for right now, I'm going to call it Tactical Finance. Tactical meaning that it's not really a broad overview of a topic, but it's really more of what can you do today, or what are some actionable steps that you can take within the next day or couple of days in order to get yourself in a better financial situation. And of course, I wouldn't be doing the world justice if I did not at least talk about the current situation that our country and that the world is facing. So right now I'm recording this in at the very end of March 31st, 2020. And of course, if you're living through these times, you understand that right now we're dealing with this COVID-19 situation, right? And as much as it is a health concern and a health issue, health crisis, this is also impacting the financial world quite heavily as well. A lot of companies are moving towards figuring out how to work from home. A lot of school districts and government entities are trying to do the same. And in a whole, I think it's caused a lot of disruption in not only the way that we live our lives, but the way that businesses are running. And as a result, it's causing the markets out there to fluctuate and be quite volatile, right? Volatile meaning, you're seeing ups and downs every day in the market. March has just been absolutely crazy. And, the past couple of years, I mean, we've had an awesome bull market for years and years and years. And I know, we're overdue, and every, I think 4 years it is that we're supposed to have a bear market, meaning that we're supposed to see a drop in about 20% of the overall market. But we haven't seen that for about 11 years now, ever since the whole 2009 issue, right, with the economy and with the housing crisis. But right now we're experiencing something that nobody could have predicted, right? And the questions that I'm getting right now specifically are around what to do with the money that you're investing today in order to take advantage of this market, frankly, to take advantage of this crisis, and two, how do we preserve any money that we already have invested in the market? And should we pull out our money? Should we be potentially investing more money? What is the right thing to do? And here are my general thoughts. I myself have always fallen into the category of being a long-term investor. All of the money that I have invested is invested within inside of tax-sheltered vehicles. In other words, 401ks, Roth IRAs, HSAs, that kind of stuff. And hopefully some of you guys are already familiar with these terms. If not, I'll definitely start having segments around, these different terminologies so that you all can get up to speed. But all of the money is being invested in these retirement accounts, right? And no matter what happens in the market, my philosophy is to always be investing at least 15% of your gross take-home pay. So if you're a household that before taxes makes $100,000 a year, you should be investing $15,000 a year in all of your retirement accounts, right? Or in total, I should say. So between your 401ks, your IRA, your spouse's IRA, you should be investing about $15,000 of your own money, not including any kind of 401k matches or anything like that, just your money. Now, some might ask, does this rule change if we see that the market is going down? And first of all, let's address that first premise. Is the market going down in the future? And the real answer, the answer that I think most people will never give you, especially if they're asking for your money for their advice or for their market timing services or for investing advice. The truth is that nobody knows what's going to happen tomorrow. Nobody knows what's going to happen in the markets next week, much less 3 weeks or 4 weeks or a year from now, for that matter. If anybody tells you that they do, they're absolutely lying, right? So as much as there could be some types of indicators to maybe suggest a certain pattern, at the end of the day, trying to time the market is not what you should be doing. When you look at the 500 largest companies in the world, the index that tracks that is called the S&P 500. So the S&P 500 over the last 40-year period has done over 10% per year, right? And if you start including inflation and dividends, you'll get about that much, 10% a year. That is not to say that every year you're going to get 10%. Of course not, right? There'll be some years where you're going to gain 30%, like last year. There are going to be some years where you gain only 6%. Some you'll lose 20%, 40, maybe even 50% of your entire portfolio. It has been shown that in the past, markets have gone down by 50% or so. And that risk tolerance is something that is really, really important for you to address and be very comfortable in understanding what that means. And let's dive into that risk tolerance in a moment. But my general philosophy is that no matter whether the markets are going up or if the markets are going down, you should always be investing at least 15% of your income, no matter what. If you are in the accumulation phase, right? You're not going into retirement in the next couple of years. You are not in retirement. You are currently accumulating. So that's anybody that's not going to retire for the foreseeable future. And for those of us that have that luxury to be able to ride out this storm, because that's all this is. This is a roller coaster ride, and right now it's getting really, really scary. It's getting scary, right? And some of us might want to jump off, but the only people who get hurt on a roller coaster are the people that jump off. The ride hasn't even ended yet. We got our seatbelts on. Let's stay on that ride. And we know that historically speaking, you will make about 10%, if we are to look at history, over the long term, 40-year periods, 20-year periods. You're going to be just fine. This is just a small hiccup, a small little scary part of the ride that everybody gets scared of, right? But it is simply something that's actually to be expected of our market, right? In fact, we are overdue, as I mentioned earlier. So the short answer is no. If you are thinking about pulling money out of the market, definitely don't do that. You want to, in fact, continue investing, maybe even invest a little bit more right now that the market is down. Now, let me quickly explain the reason why. We all know this idea of buy low, sell high, right? I think everybody here has probably heard that once or twice in their life. So we know that if we are going to open up a lemonade stand, we want to buy the lemons and the cups and the ice for as low a price as possible. And we want to sell that lemonade that we make for as high a cost as possible so that we can make a larger margin, right? That's what business is all about, right? Making that margin so you can make the profit. But for whatever reason, when it comes to investing and the psychology behind the emotions aspect behind investing, people don't think of it that way. In fact, they act the exact opposite way that they actually should. So when people are scared, they drop out. And when people are not scared and they're bullish, everybody's trying to get in. But that's actually the exact opposite thing that you should do. When other people are fearful, you should be greedy. And when other people are greedy, you should be fearful. You should maybe take a little bit more caution. In other words, right now that the market is going down, all of these stocks and companies, do you really think that they've lost that much value over this, month or so of time that we've been dealing with this? Of course not. Maybe there are some, but it's going to bounce right back once all of this is said and done and the dust settles. So right now, think about it as if you just walk into your favorite store and they're having a 40% off sale, right? And there hasn't been a 40% off sale in years and maybe even a decade. So personally, what I'm doing is I'm actually investing a little bit more money right now every single week into the markets like I normally do. And I do this in just broad-based index funds in a couple of different asset classes, right? One of them, the S&P 500. I have a couple for small cap and for REITs and for international. But generally, that's what I am doing, right? For the first time ever, I actually also opened up a taxable account where I am speculating on a couple of individual stocks, but I'm doing that with maybe $1,000 at most, a very, very small amount, just because I like doing it. And I think that these companies are solid companies that will yield me some kind of return within the next year or two, right? But when it comes to retirement investing, to me, it doesn't make any sense to do anything but continue with the course, continue investing, and maybe invest just a little bit more right now that things are on sale. Now, this next segment is going to piggyback on a topic that I discussed a little bit earlier that I said I would discuss later, and that is the topic of risk tolerance. And I don't know what I'm going to call this section yet, so I'm just kind of making up the names as I go. So I'm going to call this section Finance Simplified. How about that? Because we're going to take terms that are thrown out all the time by the media, by your financial advisors, and we are going to simplify them in a way that you can understand. So the topic of today's segment is going to be on risk tolerance. So I wanted to start off this discussion and this explanation by just giving you a bit of an analogy, right? So when you go to Vegas, I don't know if everybody here has ever been to a casino, but if you decide that you want to play the roulette table, and there's a very simple way to play that game. You could either put stuff on a number, or you can put it on black or red, right? The most simple way to play this game is by selecting either black or red. Now, if you put, $20 on black and it lands on black, then you will about double your money, right? But let's just say you took that same $20 and you put it on a number. Let's just call it the number 5. Do you believe that it is going to pay only double? Well, no, the answer is no. If you're familiar with a roulette table, the numbers, I believe it's from 0 all the way to, I think, 40 or something like that. But the point is that because you are taking a bigger risk, so think about this, it can either be red or black. And I think there's like 2 greens, but for the sake of argument, if you put your money on red, you're betting essentially that it's going to be red and not black. 50-50 chance. You're not taking a whole lot of risk, but guess what? You're not going to get a whole lot of reward for taking that bet. Now, if you put your money on a specific number, there's only 1 out of 40 or so chance that it's going to land on that number. So obviously, if you're going to take a larger risk, you are going to expect a larger reward. If not, nobody would ever take those bets. Am I right or am I wrong? I am right? Nobody would ever take a bet where you are providing, where they have to take a bigger risk but get a smaller reward for it. So let's start off with that premise. Personal finance has an emotional concept to it as well. There has to be a mix between being an aggressive investor because you want to make as much money as possible on your money, but at the same time, frankly, you need to be able to sleep well at night knowing that your money is where it is. And this idea of risk tolerance changes over the course of your life and your life situations. And I think that anybody could agree with that, right? Let's take a 25-year-old person that isn't going to retire until they're 70 or 65. If something happens to their money, right? Let's just say they have invested $10,000. The market crashes, and now that $10,000 becomes $6,000. That's a $4,000 loss or 40% loss. But that person still has 30 plus years of investing to do, right? Obviously, that person's risk tolerance should be higher than somebody who's 60, 65 years old and very close to retirement, right? That risk tolerance is highly indicative of where you are in life and what you want to do in the semi-distant future. So that being said, what does that mean for your investing philosophies? So to me, if you are somebody who's still more than 15 years away from retirement, in general, you should be sticking to primarily equities. And what I mean by equities is stocks. Every time that I talk about investing for retirement, I am talking about low-cost index funds, not individual stocks or expensive mutual funds. I'm talking about low-cost like Vanguard, Fidelity, Charles Schwab, index funds or ETF equivalents. And the reason why is because you're going to be diversified into a bunch of companies in these index funds. But back to my point is when you're young, you should have and be heavily weighted towards stocks, right? Or equities. So this is probably 90% to maybe even 100% of your portfolio should be in stocks. Now, as you're moving closer to that range of 15, 10 years away from retirement, and keep in mind that retirement may be a different age for you. Some of you want to retire early. 25-year-olds might be thinking, hey, I want to retire by the time I'm 40. What does that mean for me? Well, just kind of take these general numbers and years and kind of factor that into when you believe that you're going to retire. So as you approach retirement age or retirement time, about 15 to 10 years before, you need to start shifting your money towards things that are slightly less volatile, things that are going to protect you against your money or your stocks going down or the markets going down. And in general, this is done using bonds, right? Bonds are essentially a debt instrument, right? So when corporations or governments or municipalities need money to do something, they issue what are called bonds. And these bond index funds essentially are a group of them. And these bonds are a whole lot less volatile. So when you find that the markets, the stock market is going crazy, a lot of people flood towards the bonds. So it's essentially a hedge. Here is where the crux of it is and how it ties in to, risk versus reward. Stocks are volatile relative to bonds, but the reward that you can get from that, meaning the return that you can get from a stock, is higher than a bond, could be much higher than a bond. Now, bonds are the inverse, right? You're not taking a great risk with some of these bonds, but for not taking much risk, you're going to get a much smaller reward, maybe something like 3%, 4%, maybe even less than that, depending on the type of bond that you're doing. I will preface this and say that there are some junk bonds, meaning not very good bonds, because like I mentioned, bonds are debt, and some of these companies can default on that debt, meaning leaving you with nothing. They might be offering to pay you a large yield or a large interest, but if they default, you don't get anything, right? So I'm talking, more typical short-term, intermediate, high-grade corporate bonds will pay you maybe around 3 to 4%, at least at the time of this recording. So not very much in comparison to some stocks. Like I said, the average of the S&P is about 10%. That's like a 7% difference between the two. But the bonds offer you more stability and is a hedge against your stocks. So that is where that whole risk and reward balance comes in. So that is not to say that if you're 40 years old and you plan not to retire to your 70, that's 30 more years. That is not to say that I'm telling you that you should be 100% in stock equities. That is not what I'm trying to tell you. Like I mentioned earlier, personal finance is personal, right? So you need to be able to sleep well at night. And actually, it sounds funny, but you really should use how well you sleep at night as sort of a gauge to what your risk tolerance is, right? If you're able to sleep with the fact that you have 100% of your money in stocks, if you know what that means, right? And a good financial advisor should be able to help you to understand what that means. So let me give you a generality here, and I think it's not extremely accurate, but if you have 100% of your money in stocks, you can expect that on the worst year of the market in the market's history, you will lose about 45% of your money. If you can sleep well at night that tomorrow your money will decrease by 50%, then you should be 100% in stocks. If you cannot stomach that, then you need to adjust your ratio between stock and bonds, right? Maybe you need to move towards 50-50. What does it look like when the market drops? What is the worst year that a 50-50 split between stocks and bonds did? I don't have those numbers in front of me, but let's just imagine that they're 25%. Oh, well, I don't mind if my million turns into 750. That's not so bad if that's the worst case scenario in history. If you can sleep with that, then do it. That is your risk tolerance. And as you can see, when you have more runway, in other words, if you have a lot more time between now and when you need that money, the more risk that you can take, right? Because you want that reward. You want to be able to buy stocks when the market is low, because you know you have a long way to go before retirement, right? But then again, if you are a 25-year-old person that just cannot stomach losing 45% of their money, even though it's probably a relative small amount of money compared to what you're going to have later on in life, if you cannot stomach losing, a couple $1,000, $10,000, $20,000, then it's you need to do what is good for your mental health and your financial health, right? Also, so make sure that you understand, where you're going to fall on that scale of risk tolerance, and it's going to be very different for everybody. If you guys have any questions about that, and maybe you need help identifying where you are on that spectrum of risk tolerance and how much you should have potentially in stocks and bonds, I'd be happy to help you guys. So feel free to reach out to me via email at winyourwealth@gmail.com. If you have any questions, I'll be happy to answer them here. Well, guys, we definitely did it. We got through the very first episode of the Win Your Wealth podcast. And again, a sincere thank you for everybody that's listening in and getting some great information. If you feel like you gained some value out of this, I'd be very happy to hear it. Just leave it in the reviews. That would be extremely helpful for me. If you have any questions, reach out to me at winyourwealth@gmail.com. But again, I look forward to more and more episodes like this to help you. If you have any questions, like I said, I'd be happy to address them here on the podcast on the air to help as many people as possible. Thank you guys very much for listening and downloading my first podcast. I appreciate it very much, and I'll see you guys next time.